go. All right, Chapter 8. Now, to me, Chapter 8 kind of gives me this like feeling of Chapter 7 in a lot of ways because it's going to be hitting on a lot of topics that in 2301 y'all actually have a chapter over. So it's going to basically touch the surface of a lot of items. Again, we want to take it as we can. This whole week, we're only doing Chapter 8. So if we finish the lecture today on the notes, we'll go ahead and go over the homework on Thursday. So we can go through it all together, counting more examples. We can do that on Thursday and everything because this is the whole week, this Chapter 8. And it's going to feel a little complicated, like Chapter 7, because of all the information involved. Because this is going through liabilities and stockholders' equity. But don't worry, it's just like the surface. You're just scratching it. In 2301, you get to dive really deep into these subjects. Alright, so let's start off. And the thing that we hit first is, of course, liabilities. And I just like this graphic because it just gives you the good time frame of what a liability is. Liabilities are dealt with multiple types of transactions, but it's usually, again, us having to pay somebody. So it could be due to a past transaction or event. It could be our present obligations to pay a bill or pay our workers, to all the way to a future payment, our loans and whatnot. So when we look at liabilities themselves, there's definitely two types that we focus on. Current liabilities, which are again due within 1 year. And these are going to be mostly our accounts payable, short-term notes, wages payable, anything that we can basically pay off, again, within a year. So we'll always focus 1 year's period. Anything that's after a year, so any liabilities that are definitely our future ones, that are past a year out, these are going to be known as our long-term liabilities. And these are usually notes payable, long-term versions, bonds payable, leases, again, mortgages. So anything that you can actually already know that's going to take you over a year to pay off, you're going to have some kind of long-term liability to it. Look at these. We do have a few that we will tackle. And I'm honest on this. Looking at the 2301 material, it actually breaks this the same way. Focuses on these particular liabilities. Which is actually interesting that they both will target these specific ones. So we already know accounts payable. That's again what we usually owe to suppliers and services purchased on credit. We're not going back over that one. We beat that so bad during this course. Our one target is the brand new ones. Okay. So the first brand new one is, of course, one that we are familiar with in the state of Texas. And that is the good old sales tax payable. If you don't know what sales taxes are, you've been hiding under a rock. It's really the biggest revenue that the state of Texas has. Well, when companies basically collect this, of course, they don't get to keep the money. they basically working as an agent and have to take that back or pay it or give it to the government. If they don't, you get fines and penalties, which nobody likes. So, when we have sales tax, for our example, is Police Grocery, and they're going to collect sales tax on 10,000 of sales at 6% tax rate. So we're going to do this formula in red. We're going to take the sales, 10 grand, and times the tax rate of 6%. To show that we're going to have a sales tax of $600. Now, as we all know, when we pay money to these companies, we pay them for the sales and the tax. So they receive all that in cash. And when we put it on our tabler, very so tabler, we have to total the cash. Basically, just again, think of it in the eyes of the customer. So 10,600 is paid to us. 600 of that, again, is sales tax. And we're going to have to give that to the government. So we need that to be a payable. We're going to pay the government that money. So a liability exists. The other part, actual sales or money we made, 10,000, is part of our revenue. And of course, sales revenue as our income statement impact. But just remember again, watch out for sales tax. As a good business owner, I would always tell people, if you can, create another bank account for any money that's going to go to the government. Because the problem that ends up happening a lot of times is that companies, if it's in the regular bank account, they're going to spend it. And when the sales tax is due, they're in trouble. So, if you're a good business owner, just have a separate bank account that's just strictly for sales tax or income tax if you're going to pay that, so you don't accidentally spend it. It's just a smart thing to do. Alright. The next one we're going to tackle for liabilities is another good old favorite that you're probably going to hear about in 2301, like nearly every chapter. I don't think we've attacked it as much in this one, but it does end up becoming a famous one. That's unearned revenue. When we look at this, this is always pretty much related to deposits. Basically, the customer gave us some money for a future event or service or buying a product that we have yet to complete. A lot of times, the best examples are sports events or concerts. So, of course, your book decides to do a sports event. So, they have on August 6th, Superior University sells 10,000 season football tickets at $50 each. So naturally, 50 times 10,000 tickets gives us amount of 500,000. Now, these games have not been played yet. So, do they really earn the money yet? No. And there's your definition of unearned. Really quick. Did we really earn the money? We have yet to earn the money. It is unearned. Or not earned yet. So, we will basically have 500,000 in liabilities for unearned ticket revenue. Now, when they play that first game, they have earned a portion of the tickets that they sold. And we usually have to figure out how much did they earn. Well, if their season is 5 games, which they did that as an easy number because we know no football season is 5. Unless it's the XFL, and that's the way it went. But we would take the unearned revenue that we basically have, and we're going to divide it by how many events or services we're going to perform. This will tell us per event how much money we actually earned. So 500,000 divided by 5 for the 5 football games gives us 100K, and that we actually earn per game. Or we may actually have to refund if we don't perform the game. Because again, if you don't play the game, you will eventually have to refund tickets. That's why it's considered liability. Right now in our situation with COVID, a lot of games are getting canceled, a lot of concerts. So these artists and sports have to start refunding tickets. So they never earned them. It's now going back to the customers, which is not good for them. Listen to the stories about the NBA now starting to slash salaries and whatnot. But that is what it is. So for us, for accounting's sake, there would be 2 entries that usually happen. First entry is, of course, receiving the cash for the sale of tickets or the advancement from the customer. We would always put it as cash because we receive the money. Yeah, there's no doubt of that. But since we haven't earned it yet, it will go under unearned. Now, when we perform the job, you've completed the job or a portion of it. Because this ends up happening a lot of times with construction. And we'll figure out the per event, and we're going to remove it because we've completed that portion of that unearned. And now it's becoming revenue. So ticket revenue. So every game that's completed, we drop this down by 100K due to that's the completion of the event. So we complete 3 games, unearned ticket revenue should be 200,000, revenue should be up to 300,000. Again, to reflect how many games you completed. Okay? Put that together. Okay. A real fun one that's coming up. Those 2 were pretty simple. But we got you some notes. So notes are back. Notes payable. And again, when we look at any kind of note, these are promises to pay a specific amount within pretty much a year. Okay? These are known as short term. Okay? Now, when we look at those, again, we have a promise to pay this amount. But with notes, they have a thing that's always attached, and that's going to be interest. So when we have interest in itself, we have, of course, have to remember how to calculate it. For us, this one's actually hidden. we have to look at the principal of the note, which is basically the amount that's borrowed, or face value of the note, times the rate. So whatever the annual interest rate is. And then we're going to multiply it by time. So, since these are short-term notes, it's usually a fraction out of 365 days. So if we get lucky and they're in months, you can use months. Like if it's a 4-month note, well, 4 divided by 12. Always a fraction. So, let's assume on September 1st, 2017, Cole Williams Co. signs a $100,000 12% 4-month note maturing on January 1st with First National. Okay? These are typical notes. Usually we do a note with a bank to get cash. And sometimes that cash in itself is due to probably paying some payroll, most likely later on, or paying some type of bills. So the first thing we have to do is recognize that note. So in our tabular, when we recognize the note, it will be basically recognizing cash coming in. So we have our cash. And then recognizing the liability of notes payable. So we are expected to pay $100K. Okay? Again, we haven't paid it yet, so we're only expecting it. But we do have our cash in themselves. Okay? So there's us recognizing the note. But we gotta figure out interest. Now, usually with these notes, interest isn't paid until the note has matured. So, we have this interesting thing. And we have the formula right here. I don't think I corrected the dates. Okay. So here's our formula going on. Which is funny because I had a split period. Huh. I don't recognize this. This probably was supposed to be later on, but I'm going to go ahead and hit it anyway because it works. So, interest. Now, when we have interest, I'll talk about all fun things about interest in just a sec. Interest does have to be recognized in the period in which we earned. Okay? Now, sometimes with notes, especially notes done at closer to the end of the year, we will have to accrue interest. And when we talk about accruing interest, all that means is that we recognize a portion of interest as revenue in the period it has been earned. That does not mean the company has paid it, or in this case it's interest expense, but we do recognize how much we have to have the liability. So, when we look at this, it will have a split interest in some cases. But all that really does, again, is just recognizing interest in that period. So, same formulas as they go. Your book actually does not do an actual example of that. That's fine. But if you do run across, like if we do have one in the homework, then I will go over that portion with it. But if not, then that's fine. Again, that may be just a little extra detail to prepare you for 2301. Because, again, they're just trying to scratch the surface. So, right here is our interest formula in action. Well, we have $100,000 times our rate, so those are principal, our rate, times our time, 4 divided by 12 equals to 4,000. Okay? Looks like they did accrue it. They're going to pay on January 1st, 2018. So they are showing it. They just didn't split the interest. Okay. So when we look at it, here's our formula. This is the amount of interest we're expected to pay. The note for our example ended on December 31st. We're paying it on January 1st. Alright. So they're actually showing the tabular for interest accruing. Now I see where I'm at, because there's a little line. But basically, when we accrue interest, we're going to highlight interest payable, because again, we owe the interest. We have to pay it, but we just haven't paid it yet. And then we're going to hit expense. Those $4,000. Okay? So this is December 31st that this tabular is doing. Because again, we're paying it in the next period. So we don't have any interest since it's the next day. But whenever we have the expense, it will be under interest. Because it's all about interest. That's what notes love. Now, the note has matured on January 1st. Again, when we talk about maturity date or any of that, that means it hit its due date, its end of its life. And when it hits those, we also have to record. Because what are we doing when it hits its due date? We're paying it off. Okay? So, to pay it off, first off, this is, again, how the accounts are on December 31st for notes payable and interest payable. So they have two liabilities, which we have to pay off. So when we do this, we're of course going to affect on cash the total of the notes payable and interest payable. We then basically reduce the note payable and interest payable by how much is in there for that note. So, since the principal was $100K, it's reducing by $100,000 since it's been paid off. And the same thing with interest. As we can see, it's being completely paid off. That's why we have the cash of $104,000. Also, this doesn't affect the income statement at all since it's all on the balance sheet. Basically, again, removing liabilities. We already recognized both of these earlier. Okay? Well, yeah, this is a very simplistic version of how notes work. 2301, you're going to have some fun. So, any questions so far? The biggest thing to watch out with the notes, again, is going to be interest. But once you've got the interest down, it's really a step-by-step process of recognizing everything. And again, what I would probably suggest after today is go ahead and try the homework, and then we'll do the homework on Thursday. So we'll do it as a class and go through it all so y'all can understand, so y'all can prepare for that last exam, because I know our guys are going to do awesome at it. And if not, we'll try our best to get y'all to be awesome. Because again, we get to close up shop a week early. So, 2 chapters. I think y'all guys can handle it. Actually, I know you guys can handle it. There's no thing. Alright. So the next liability we're going to tackle is payroll. I know one of our favorite subjects that we have in the good old payroll in itself. And when we talk about payroll, I like to look at these fun little graphics. You get something that's known as gross pay. If you don't know what gross pay is, this is what you actually earn. This is how much hours you work multiplied by your rate per hour. But unfortunately, we all know that's not what you get. And I do love this graphic because she's all happy, going, yay, I got my paycheck. And then she looks at it and is like, oh my God. I get so little. I think this is all of our expressions when we see our paycheck. But the reason why is, again, a lot of payroll deductions end up coming out. For most of us, we're going to see, FICA. And FICA is your Social Security and Medicare. So, that is the Federal Insurance Contributions Act, FICA. Then, of course, you have federal income tax. So, our FIT is being basically taken out, and this begins to help us pay our taxes when it comes to April 15th. I'll already tell you this, you have more power of how much that comes out than anything. And that does not mean just doing a W-4. You can tell your payroll how much to take out. That's a given. If you happen to be in Louisiana, Arkansas, Oklahoma, New Mexico, any state around us, they also will withdraw state income tax on SIT, as we talk about in payroll tax. It's usually state and local tax. They put state and city tax, same thing. But we like local because it's truly lit. And next thing you got is volunteer. One is charity. You can volunteer and have charity automatically deducted. You can have insurance, pension, or even union dues. You're part of the union. Those are all pretty much voluntary. So, good multiple choice for definitions. And here I am giving it that local treatment. But, again, gross pay is your total compensation, while federal is paying for your income tax, state income tax, and then here's FICA. Now, this is a little added information just to help y'all out, or to show. But FICA in itself, again, is broken up into Social Security and Medicare taxes. In fact, Social Security is also known as OSADI, which is basically old age survivorship disability insurance. It's the funniest one because the government actually putting in old age in their acronym. They couldn't think of retirement, but they thought of old age. So, again, we're going to cover our retirement, disability, and survivorship insurance. Medicare, again, is a high health insurance, so for medical benefits. These items, again, help you out on knowing what's the limits. Always keep a check of this, okay? Because it does change. But as of 2019, it was 6.2% on the first 132,900 of earnings that you made. Okay? Medicare don't care. Medicare is basically 1.45 on all earnings, so there is a limit. But once you hit above 200K, expect an extra 0.9% to be added on. And of course, here's your voluntary. And then the employer side has a couple more items that they focus on with payroll. And that includes FICA. When we look at that, they also pay the same amount as you paid for FICA for Social Security and Medicare. So they will also pay the 6.2% and the 1.45%. They also will now have to focus on unemployment with FUTA and SUTA, federal and state. When we look at FUTA, this is usually on the first 7,000 of earnings in a calendar year per employee. So we look at each of them and see when they reach 7,000. We take the total that they have earned, and if you only pay in FUTA, that'd be 6%. But if you also pay into the buddy, SUTA, the federal government will actually drop your unemployment down to where you only pay 6.6%. But the remaining 5.4 usually will go to the states to help with their unemployment. So, with SUTA, instead of paying the federal government, we pay the state government. Usually the 5.4% typical is in most states. Again, they're going to follow that $7,000 rule. But for Texas does not follow that trend. First off, Texas will take this rate and they put a merit basis on it, which basically means if you have a low turnover rate of employees, they will actually lower that rate. The lowest for 2019 was 0.36%. But if you do have a high turnover, a lot of employees coming in and out, you can actually see your rate increase to above that 5.4 to all the way up to 6.36%. And for us, and state of Texas, they like to go instead of $7,000 to $9,000 of the first wages for each employee. So again, this is why payroll is so big of an expense for most businesses. There's a lot attached. Okay? Now, it's good to know for the state of Texas, because that's the one we live in, but for if SUTA does pop up in your homework, it will be only doing the basic, the typical charge that most states charge. Okay? So, cool thing about your book is that it's going to give you pretty much all the amounts and then have you just go put it in the right payroll. And this is also why I just took it from the book to show you the tabular that way. It's not going to go overly complicated in payroll. Again, you're going to have courses that deal with that. So, for our example, of course, we got cargo. Payroll records show the following. Payroll for week of March 7th. And they're going to show the payment of the employer share. So, of course, right here shows exactly how payroll gets paid out. We look at the first one right now is the salaries and wages being accounted for. So we know we have to pay FICA of $7,650. Federal, we're going to pay because these are payables, $21,864. State, we're going to give the state government $2,922. And then our total salary and wages are basically our net pay. This is what this is $67,564. Okay? The book's really just going to give you these numbers and go, here you go, just put it in. So, again, just make sure you match the accounts with the right numbers, and then they may leave off gross pay. If it's gross pay, that is considered an expense for us. Okay? This is our salary and wages expense. So that is our gross pay. When it's time for payroll to actually be purchased, paid, sorry. It works like any other liability. We're going to pay our workers their money, so the net pay, and we're going to take it away from the liability. All we're going to do. They're trying to keep this as simple as possible in the first payroll. So I didn't see too much of calculations. Again, this is extra stuff for you, but it's always good to know the calculations because I do know that sometimes you want to know how they are calculated. So, here is the employer side. And for the employer, here they are paying the FICA. Yeah, these are just generic numbers. These are numbers that the book is going to give you. So, the book for every problem, if there's a payroll problem, they're just going to give you the numbers and tell you to stick it in the tabular. And I'm going to already tell you for the exam, if I give you anything of payroll, it's probably going to be multiple choice. It's not going to be a workout problem. So, for me, I'd rather give you the simplistic version because I already know you're going to hit the hard part. The most focused one that I would probably focus on as a workout problem right now will probably be something from the notes payable. That's just me as I'm piecing it together, and probably bonds. Because bonds is another big part of this chapter. But again, just knowing exactly where it goes So it's going to give you employer paid, blah, blah, blah. Paid FICA, $7,650. Unemployment, UDA and SUDA. And then just know that the expense is going to be payroll tax expense. Okay? Again, as we see, there are negatives. Okay? That's really it for payroll. Again, you're going to see this a lot more in 2301. You go more in depth into payroll. And then, I believe you have it in your business tax course. If you're, again, if you stay as an accounting major with Lone Star. Alright. So, that's basically a lot of our short-term liabilities right there, our main culprits. Now let's look at a little bit of long-term liabilities, or basically debt finance. It's another way we like to call long-term liabilities. And the number one main focus is bonds. And bonds in themselves are basically a documentation, kind of like a long-term note, or a long-term balloon note, if you want to look at it that way, where we receive money from investors. So this is what's going on. They purchase our bond. And during this life cycle, once they purchase the bond, we're going to issue them out a bond certificate. And then, twice a year, usually semi-annual, we're going to pay them an interest payment. So, you get the interest payment, and then at the end of the life of the bond, the corporation will pay the investor the par value of the bond, or basically the face value. So, we have a few things going on, but usually these are good investments, especially if it's a government one, treasury bonds, or municipal bonds. And you want to look at those. Again, cool thing with those are non-taxable. They're a non-taxable bond on the interest you receive. And plus, they're not going to go bankrupt. City, the state, the federal government, they're not going to go bankrupt. So at least you're going to get the money back for the bond. That's a nice little thing. Corporations, a little bit more riskier. But you do get interest on top of getting basically most of your money back for the bond itself. So, again, you're going to receive the bond certificate. You're also going to receive something called a bond indenture. Basically, this is your contract. The legal mumbo-jumbo that comes with the bond. And it's going to go over lots of rights and procedures. The main ones it's going to hit is, of course, where do you fall in line in a bankrupt proceeding to basically claim on the company's assets? What's your seniority? Second thing that it likes to hit on is what happens when the corporation basically defaults. Doesn't pay the interest or the maturity at end date. So, they'll go through all those and whatnot, just a basic contract. The certificate is just a nice fancy piece of paper. I like to say it's nice and fancy. I don't think I actually have a picture of one. But basically, with this one, it's a big document. Nowadays, it's all electronic, so you don't get it. But if you want one, you can always request it, and they'll send you one. You can frame it. But with these bond certificates are going to show multiple items. Again, they're going to show the face value, the amount of principal that's due, the maturity date, the due date of the bond, and usually bonds are like almost, could be 5 years to almost 15, 20 years. Again, a long-term investment for our investors. And it's also going to have what is called a contractual interest rate, or stated rate, or coupon rate. Yeah, a few terms for it. And this rate alone will basically be determined by the company based on its ability to make interest payments. And little other items. And it's going to be used with par value to calculate the dollar amount of periodic interest payments. So we're going to get back into interest payment. Fun story here. The reason why it's called a coupon rate is back before electronics and these bonds were issued no matter what paper. They used to have on the bottom peripheral paper that you can basically tear out, and these paper look like coupons. This was for your interest. What you would have to do was, when the due date came to get your interest, you would take it off that bond, and then you would mail it to the company, so the company can send you the check. And again, they couldn't keep track of everybody that has a bond, or when it sells. And again, bonds get traded. So that was the way the companies basically were able to maintain who gets paid the interest. Nowadays, it's all electronic, so as soon as someone sells the bond, the company's going to be aware of where to pay the interest. But it's always fun knowing the history of business. The other rate that we do look at too, especially when it comes to bonds, is known as market rate. And this is the interest rate that issuers are willing to pay and investors are willing to accept for a bond given its characteristics. And this is mostly how risky is the bond. If a company's on the verge of bankruptcy, that's a high-risk bond, because mostly guaranteed you're not getting it back. So you probably would not want to invest in that bond. But this is what ends up happening. So our market rate and our contractual rate. And your book actually does show the rates. Now, when the contract rate is greater than the market interest rate, as you can see it's 10%, market interest rate is 8. This is a bond selling for a premium. Okay? So it's going to sell higher than what usually the par value. That's what premium is. Selling higher than par value. If it's the same, it's going to sell at face value. So basically for par. Whatever's on the contract, it's selling exactly the same. And then of course, if the market interest rate is higher than our contractual rate, it's going to sell for a discount. Basically, it's selling for lower than the cash we want. When we look at this, I like to always put it into, wait, we know it's shopping. And when we look at shopping, it's mostly supply and demand. A lot of times, the same thing with bonds. But when something sells for a premium, this is something that's rare, that everybody wants, usually think about Christmas time with a hot toy. Famous one, of course, is Tickle Me Elmo, where that was the infancy of eBay. And if you ever saw the mad rush on Tickle Me Elmos, eBay was selling those things for over $1,000 back when it first came out. It was that high of demand. So customers saw that as we're willing to pay a higher price for it to get that product. Same thing with bonds. If I told you Apple was going to issue a bond, well, odds on there's going to be a high demand for it. Because again, it's Apple. It's not going to go bankrupt. We don't believe it's going to go bankrupt. So, they'll sell higher. We want to pay more to get it. So that's guaranteed. Okay? Face value is just basically us going to the grocery store and just buying our milk or any food. We're okay with the price. We think it's fair. There's not really a demand for it. We just go and grab it. But discounts. We look at shopping. Discounts again is when we know how much it's worth, but we don't think it's really worth that. So we're going to wait on it and try and get it at a lower price. And a lot of times Black Friday shopping, we wait until it gets discounted. And that's when we pounce. So same thing here. The company that investors don't have a lot of faith in, no matter how much we want to issue the bond for, they're just not going to go for it because they don't think it's worth that much. So this is again like if GameStop came out and go, I want to issue a bond, and everybody knows GameStop is not doing well. Well, I don't have faith enough to get it at face value. There's not going to be a lot of demand for it to be selling higher. So people are going to wait for a discount. So, how will we all account this in your tablers? Well, first, we're going to account for the issuing of a bond. And we're going to look at face value first. Okay? So, again, we're going to issue the bond at its par value. So we have Devler Corporation. They're going to issue a 5-year, 10%, 100,000 bond. And it's going to be dated January 1st, 2017 at 100. Now, when we see this, biggest thing to watch out for when you're looking at bonds is when it says at something, at a number. This is a percentage. Okay? Financial companies, they don't like to actually put the percent symbol. They just like to put it as a whole number, and that's it. So, when we look at 100%, basically it's sold at face value. So, it's sold for exactly how much we want it for. Keep an eye on this, because if it's higher than 100, if it's sold at 103, that'll be a premium. It's higher than its face value. If it's below 100, like it's sold at 95, that's a discount. We'll get into those. But I just want y'all to keep an eye out for it. Okay? So again, this one's sold at par. So, first off, the issuing of the bond. Basically, we got for cash, so we have 100K coming into us for this bond. Investor paid it. And again, we're going to owe this bond later in its life when it finally matures. So, since we owe this bond, we have a liability, bonds payable. And that's going to hold $100K. Nothing is going to affect income statement when the bond is issued. So be careful of that also. Okay? So it's only cash and bonds payable. But we do have to make interest. Okay? Now, since this one did not give how many times we're going to pay interest, we're probably going to give it at the end of the year, which now it actually does state at the end of the year, the interest payment is being made. Now, watch out again, because this book loves to do this. I don't know why it loves to do this, but it will always do interest payable. It likes to accrue. Usually we don't accrue on bond, we pay it that day. But this one they say that they pay on January 1st. Which, this is annoying, but when we look at this, again, same formula that we're going to have. 100,000. So, par, or face value of the bond, times 10%. And since they're going to pay this at the end of the year, okay, started on January 1st, and since it's going to get basically going for till December, it's 12 months, divided by 12, so basically 1, and that's going to equal out to 10,000. Okay, so the same formula that we got going on with interest. So when we calculate this is showing the whole process. So here was our issuing, January 1st, and then here is our interest accrual. Okay, so December 31st, they're showing the interest payable. So again, interest up here, just like we did all the way up here with the note. So there's the note right there. So same things are happening with interest. Don't be afraid. A lot of these uses the same concept. Okay? So interest payable. There's our expense for interest. Only time you recognize anything on the income statement right now. And then January 1st, 2018. That's when they make the payment. Only for the interest. Okay? So cash will go down by 10K. Because again, we're paying the interest. So our interest payable will also decrease by 10,000. Okay? And that's going to be the same payment we're going to make for this bond during its life. So at the end of every year, for 5 years, we're going to do the same action. We're going to do the interest payable and pay the interest the following year. Okay. It's usually always the same entry. There is nothing that changes when it comes to interest. But that's if it's a perfect world and it sells always at face value. You already know it ain't a perfect world. So it's going to sell at different values in itself. First one we're going to look at is discount. Now, what is the discount? This is what's going on. Okay? We have on January 1st, 2017, we have Candlestick Inc. They're selling a 100,000 bond. That's 5 years. So again, it won't mature for 5 years. 10%. So there's our rate. Bond at 98. Okay. And again, they like to pay the interest on January 1st. So they always accrued interest. If they really like to have that practice for you. But for this, again, remember I said watch out for these acts. Since it's below 100, this means a discount is happening. We got less cash. Okay? So the first thing we have to do is basically calculate the discount on bonds payable, which is taking your 100,000, that's your par, and times by 2%. Where does 2% came from? Well, that's the difference of the 100, so if it's sold at face value, minus 98. This is our 2%. And what do you know? Discount is a contra liability account. So, since it's a contra, it will actually deduct from bonds payable. So anytime we put this in our tablet or discount, it will be a negative number. Be careful of that. Okay? Discount on bonds payable is a negative number. So when we calculate, we do come out to 2,000. Again, that's only taking the 100,000 and multiplied by 0.02, 2%. Okay? So, when it's in your tablet, you take the 100,000, that's our par, face value. Bonds payable is always face value. So, no matter what it is, that's your bond payable. Okay? Discount on bonds payable is the number that we just calculated, $2,000. Again, it's a negative. To figure out cash, all you do is take the formula of bonds and discount. Basically 100,000 minus 2,000. Which your cash comes out to 98,000. Okay? It's really all we're doing on an issuing of a bond at discount. Now, your book does show the cost of borrowing under a discount, and you may end up having this happening. You have to calculate this for our homework. All this means is that it's looking at the life of the bond. And so this is the life. Principal at maturity. Basically, again, 100,000. Since we know interest, you can calculate your interest at the end of the year. since we already basically done the formula up here, this is the same bond, just issuing out a discount instead of par. You take your interest payments. We're only going to be making 5. So 10,000 times 5 is 50K. So when the total cash to be paid by bondholders is the maturity plus the interest is 150,000. Then we'll subtract the cash we received. So 98K tells us this is how much it costs us to basically issue out the bond. About 52,000. That's the cost of borrowing. That's why it's trying to tell you is that if I issue out 100K bond and it's only going to fetch me 98,000, then overall the cost to have the bond is going to be about 52,000. That's all it really is. It's a little formula for you. But we have no accounting here because we're already accounting up here. Put that down a little bit. The unfortunate part about discounts is that they do have to be amortized. So they're kind of being depreciated during the life of the bond. Mostly because of this. When it comes to maturity date, the only liability we should see when it comes to bonds at maturity date should be bonds payable. And basically this is having what we call carrying value. Right now, I look at this, the carrying value of this bond is 98,000. So 100K minus 2,000. So during the life, to get to par value, we have to slowly remove the discount. Basically, we're going to allocate the benefits of it to our income statement. And basically, how is that done? Okay? Well, it's like straight line. Straight line depreciation back. And this graphic really just shows what we're doing. And that's really all that it talks about. It doesn't actually have you perform it. I forgot that it doesn't have you perform it. I'm thinking 2301 that does that. Really, all it does is give you the graph. It just wants you to know about it. That's the cool part. I'll go with that. Let's stop there. I was thinking I'm going to have to explain all that. But it's basically like straight line, and it really just wants you to see that the carrying value of the bond will slowly increase as the years go, because we're going from the cash amount, and we need to reach 100K. Oh, I'm so glad on that, because that would have confused y'all pretty good. Yay! So we're only looking at issuing the bond. That's nice. Alright. Alright. So going to the issues again. We're going to look now at premium. Again, we don't have to do the whole calculations of the interest payments with amortizing of discount. So, we're just focusing on issuing in 2301. You get to deal with the journal entries of dealing with interest on these bonds. Again, that's one whole chapter just on that. So, issuing bonds at premium. Because I forgot that this whole chapter is also dealing with stock too. So we can't put all that information in one chapter. These intro guys are nuts. But premiums, when we look at premiums, they actually add to the value of the bond. And they are selling at a higher rate. So again, Candlestick is issuing out this bond, but this time they issue it at 102. Okay? So we can see it's higher than 100. When it's higher than 100, we know it's a premium. Okay? Since we only know this, we can calculate the discount. That's not supposed to be discount, that's supposed to be premium. Oops. Premium on bonds payable. And it's basically the same formula. All we do is take the 100,000 face value and multiply it by the difference of wherever the premium rate is minus 100. So this is again a 2% difference. This is how the book would like to do it for you as an example. So again, 100,000 times 2% for difference would equal to 2,000. And notice this. Premiums again will add, so it's a positive liability. Okay? So again, under this formula, bonds payable plus our premium shows us that we made cash of 102,000. Again, this is a good way to double check. If you know this is higher than 100, then your cash should always be higher than your bonds payable. Okay, then face value. Opposite for discount should be below. So, all we're doing is the same issuing. The only thing is be careful if it's a premium or a discount. Discounts will show up as a negative. Premiums will show up as a positive. Okay? So, when we look at the cost of borrowing and we got a premium, there's also an equal factor. Is that, since it's the same bond, these information is the same, but the 100,000, again, interest is 10,000 a year times 5 and give us 50,000. So, during the life of the bond, we want to pay out 150K. Well, we received 102,000 from the basically investor. So that means the cost of borrowing when it's a premium is only 48,000. And when we amortize, okay, so basically amortizing of a premium, again, the only liability we would ever want on the books when the bond matures are its due date. Basically, at its due date, we have to pay the investor is the actual carrying value or its par value. So we want bonds payable to be the only thing at the due date. So that means we have to basically allocate out the premium. So basically it's going to be the carrying value, again, is higher than the par value, and we need to get it to par value. So over the life, it will slowly decrease till it reaches that at the due date. That's really all it's showing. It's trying to just give you the basic concept. In 2301, you again will go over how to actually account for the interest and the amortization of that premium. Now, when we look at bonds and the redeem, basically it's hit the due date. It's made it to its life. It's going to always be equal to its face value. Again, that's why I've been saying, that's why we amortize discounts and premiums. So when it matures, it is just going to be basically us paying off the bond itself. So balance of bond was $100,000. We're going to pay cash of $100K and decrease the bond by $100,000. That's all we're going to do. That's really all the book wants you to know about bonds. Again, once you get to 2301, you're going to dive deeper into these. This is its own chapter. Okay? Not a bad chapter, we'll say that. But you get to learn all how we amortize those fund items. Okay? Next item that chapter 8 hits on. Again, basic concepts is stock. Okay? And it hit debt finance, now it's saying equity finance. This is what equity finance is. It's basically stock. How do we issue out stock, and what do people have of this? What is their rights? And how we purchase stock back. So, very quick on the graphics. Stockholders have the right to, well, basically, a common stockholder will have the right to vote. And they get to vote on the board of directors. Basically, that's the big thing. And they either give their yay or nay on certain things that the board wants to do. But basically, the stockholders, their main right is the hiring of the board of directors. They don't have anything to deal with management of the company. Corporations who deal with stockholders, stockholders have no rights. They can't boss the corporation. They are not really considered owners. It's just a different form of investing. But what the corporation can do is they can share their earnings. When they share their earnings, this is what, again, we call as a dividend. Investors get their money. This guy looks so happy. I don't think he even changed his face. I think they just flipped him. Sometimes the graphics in this book is just like, wow. Anyway, another thing that they get as a right is known as a preemptive right. Basically what happens, they get to keep their percentage of ownership when new shares of stock are issued. Basically when new shares are done, or out, or stock, the company is going to go to the stockholders and go, would you like to purchase, if they get first dibs, to keep your percentage of the company? And usually they'll go yes, and keep their percentage. Or they can say no. It's up to them. But it is a preemptive right and get first dibs. Last one, they get a share in assets upon liquidation. And this is usually in proportion to their holdings, which is known as a residual claim. But, of course, they are after the creditors, the lenders, so basically it's what's left that they get the claims on. So always got to pay off your bills before the stockholders get any money. I think that's gone for. It is gone. So the book's going to give you a quick definition of authorized shares, and this is basically shares that the corporation says they're going to issue out, or how much shares that they have, when they create what they call a corporate charter. All it is, basically that's the definition, authorized shares, stock. Like a little bullet point. So important. Okay. We'll actually probably separate that example so it's with the tabular. Alright. Stock issued at par. Now, they have very similarities to bonds. I will say that. And stock can be issued at two values, par and premium. Okay? When stock is issued at par, that's again, they are basically sold at face value. Usually though, this is very hard, because companies typically will put their par value as the smallest they can legally. This is where we get the statement of penny stocks. Okay? But it's always assigned per the corporate charter, and again, minimum legal value. There's also types of stock known as no par. And no par has basically value of what we basically trade that stock for. And of course, then there's stated. Stated value acts like par. Be careful, the books love to throw those three items. So for most companies, they'll do it par. So let's assume with Hydroslide Inc. They're going to issue 1,000 shares of $1 par value. Thank you. And the common stock for cash. So when we calculate the cash we're going to receive, we always take the shares and multiply it by how much it is. So, dollar per share. So this tells us we're going to receive $1,000 in cash. So in our tabular, we're going to show cash being received, $1,000. And again, the reason why is that we have common stock of $1,000 that got issued. Okay? It has no effect on the income statement. That's nice. It's always nice when shares are issued out at par. Very easy. But you also want to see a brand new account right here. Paid in capital in excess. This fun little account comes when stock is typically sold at a premium. At a premium. So, usually above par value. When this happens, one, I'll tell you, this table will come in handy for you. It just helps you keep things out. But basically, instead of hypersign issuing out for $1, like the face value of it, they issue it out for $5. So, things that we have to recognize. Common stock is always at par. Okay? So that means we recognize the 1,000 shares being issued at its par value. So still $1,000. Any amount in excess, we have to recognize as separate. Okay? So this basically states this, that we take the shares and we're going to multiply it by the difference of the issued price minus par value. So basically, $5 minus 1 means $4. So we still at $4 above par. So that means we have an extra $4,000. That was in excess. That is still capital, or still equity for us. Stockholders invested on that stock. So when we look at cash, you can do cash two ways if you're doing this table. You can add these two numbers up. That'll get you your $5,000. Or it can be easy. Take the shares, times it how much you sold them for, or issue them out for. So 1,000 times 5, so it'll come out to $5,000. So when we look at tabular, this means cash will have that $5,000 increase. Common stock is its par value, so 1,000, and paid in excess will have that $4,000. Again, if you use this chart, it makes life a lot easier, okay, because it's already pieced out. Then all you have to do is insert the numbers in the right account. Again, it double checks to make sure you're doing your math correctly. So, that's nice, but what happens when a company wants to purchase its own stock? Which happens actually a lot. Companies do purchase, as you can see with the graphic. 62% of corporations have treasury stock. And treasury stock is basically a contra equity account, which means on our tabular, it is going to show up as a negative number. So be careful of that. So when treasury stock is issued, or repurchased, basically, should say repurchase, issued, because we're not getting into that. When we repurchase it, corporation will typically do this for multiple reasons. One is probably everyone trying to acquire another company, so they repurchase theirs so they can use it in part of the buying a company. Two, could be avoiding a takeover. If they start seeing one investor getting closer and closer to having majority, they will buy back their own stock to prevent that. They may use it as compensation. This is your stock options. Okay? For our CEOs, CFOs, our corporate guys. They may also want to maintain a strong liquid market for company stock by showing confidence in their own current price. I just call that manipulating the market. That's all it is. Trying to keep those prices high. So how are we going to account for these? Well, we're going to use a popular method, probably the easiest one too, and this is known as the cost method. Basically, we're going to recognize treasury stock for basically how much it costs us to get it back, get our stock back. This will be our new par value and the base value for the stock. So, your book basically is going to show this example for purchase. We're going to use Need Inc. They give you this nice little balance sheet. And we're going to get back to this balance sheet in a sec. But this does show us our common stock. And our common stock has a current par value of $5 with 400 shares authorized, but only 100 shares issued. Okay? All that means is that they actually sent those out, and if they're outstanding, they are with the investors. All that outstanding means is that the investors hold them. They hold the stock. Retained earnings is $200K. They don't even have additional paid in capital or paid in excess. That's fine. It's just a partial balance sheet. We're only looking at equity. So we're going to assume on February 1st, 2017, Mead has decided to acquire 4,000 shares of its stock at $8 per share. So just like we did on common stock, we take the shares and times it by the per share buyback price, which is $8. Since this is a buyback, this immediately tells us this is treasury stock. Okay? So, when we look at this is your tabular. It's of course showing the balances up here of equity. So there's our common stock. There's our retained earnings. Right here we have treasury. Notice again, it's a negative. And it's a contra equity account. And basically it has to match because we paid this amount. We issued out 32K. Or we bought 32,000 of our stock. And that's really all that they cared about in this. That was all that they cared about. Ooh. 2301 will be a little bit more in-depth treasury stock. Just a little bit. Because they go back into how we issue it. Here, all we want to know is how to buy it back and how does it look on the tablet. That's really all it is. That's so nice. Alright. That was really nice by them. Gotta give them that credit. They're not, again, scratching the surface. All you're doing. I'm just foreshadowing what you're going to learn next semester in 2301. Alright. So, our balance sheet's going to look pretty much like this. After treasury stock, again, it's going to reduce stockholders' equity. So here's everything before. There's your balance sheet. And then all we do after total paid in capital and retained earnings is that we insert treasury stock. And we allow our investors, or whoever looks at financial statements, to know how many shares are in treasury stock right now, which is 4,000. So again, cost point is 32K, and we just subtract to find out our total stockholders' equity. And that's it for treasury stock. Sweet. So, the next item, this is really doing okay. There's our ratios, and that's about, yeah, we're almost done. Sweet. So, accounting for dividends. Dividends is now changed. And dividends, we have to take into account 3 important dates. First off is the date of declaration, the date of record, and the date of payment. Whenever the date of declaration comes around, this is when a company's board of directors state that they will issue out a dividend. Okay? So they said, we're going to give to our 100 shares of $10 par value common stock a 50-cent per share dividend. Yay! So it's our job to calculate how much dividend you have. Well, again, just like we've done with stocks, take the shares, times it by our dividend per share of 50 cents, and we find out that we have 50,000 dividends that the board of directors just declared. Now, since it's date of declaration, we have not paid anything, but the company has to recognize how much dividends are being paid. So, we'll make our dividends payable account. Now we'll have 50,000. And then we're going to show and retain earnings that dividends being affected of negative 50,000. And remember, dividends is a contra to retain earnings. So it always shows up as a negative. So now we have this amount. Well, the next date that we look at is known as date of record. There is no entry required here. We're not going to tabular on date of record. All it's showing is to look at who owns the shares of stock and entitled to the dividend. Okay? So how much dividends does each of our stockholders get? All that date is. But soon after that date comes date of payment. So they're going to pay these dividends on January 20th. So this is our current balance in dividends. Dividends payable, showing dividend happening. That was back, well, they don't really give us a date. We'll probably do December 31st. Okay. But here on January 20th, there's our cash filing going out to pay off this liability. Basically a bill to our stockholders for the dividends that they should receive. And that's all dividends. All we're going to recognize now with dividends in Chapter 8. On concepts. Now, they do talk about this. They haven't talked about them before, but they do talk about this. This is nice. Alright, so I'm going to show you this real quick. There is 2 types of stockholders out there. There is the common stockholders and the preferred stockholders. And for some reason the book probably mentions preferred stockholders and the dividends. Go figure. Basically, one of the advantages of being a preferred stockholder, you always get your dividends first. That's the nice part. Problem is, if a company does not issue dividends, it becomes cumulative. Basically, you again are guaranteed these dividends. They become known as dividends in arrears. We don't make journal entries for these. We just have to keep track of how much dividends preferred stockholders are guaranteed. So, again, dividends have no really actual obligation to pay. It's only when the company declares it. So when we look at this, it probably will give you like one workout problem. And basically it's going to fall like this. This is a really down and dirty example. We have Precise. Precise Corporation has stock outstanding as follows. 100,000 shares of 10% cumulative, non-participating preferred stock of 100 par, and 100 shares of $5 par value common stock. Okay. During the first 2 years of operations, the following amounts were distributed as dividends. Okay. So, we have first year, 500,000. Second year, 1,500,000. Third year, 3 million. They want to know how much does each one get paid in dividends each year. Okay? First thing that we have is that we have to figure out how much preferred stock gives. So, 100,000 times $100 par, because you have to do that. That's how much money we have, okay, in preferred stock. If it ever gives you the 10% cumulative, that's basically timing the 10 million by 10%. So, this is just saying this is how much dividends preferred stock gets in total. So, every time dividends are declared, or every basically year, preferred stock is supposed to get $1 million worth of dividends. Okay? So, when we look at dividend preferences, common stock kind of gets shot right here. Okay? First off, when we look at year one, company only issues out 500,000 dividends. We look at here, this is how much preferred stock will get. They didn't get their money. So, what happens is that preferred gets to keep basically the 500K, common gets nothing. Preferred gets it all due to, again, they have first dibs, and they have to get paid off first. They have to get paid at least $1 million. Now, this is what's really happening in year one. You're supposed to receive $1 million. They only received 500K, meaning that we still have 500,000 to basically give in dividends to preferred. But year two hits. Well, year two states that they get another $1 million in dividends. So right now, this is how much dividends they should get paid. Again, it adds on until we pay them off. So year two, as it's an example, is miraculously 1,500,000. So that basically catches up our preferred stock. They have now been issued out the dividends. Okay? But year 3 comes along. Remember, year 3, again, preferred gets its $1 million. This time, it's over $1 million, which is nice. So that means preferred stock gets its pay. So it gets its $1 million. That leaves $2 million for common stock. So common stock will get its $2 million. Finally, it gets some dividends. This is why a lot of corporations do not do it preferred. Because again, that added, have to eventually pay them kind of thing. Or it's going to be a lot of money if it keeps adding up each year. And if you're only paying preferred the dividends and common stock doesn't get any, then you're not going to get investors for common stock. So that's one of the big things that why investors invest, for dividends. But that was just a really quick of dividend preferences. Nothing too bad. So, the last little parts are about ratios. So again, a little bit of analysis. So, the first analysis that we have is known as the payout ratio. Okay? And payout ratio is simple as this. It's going to measure the percentage of earnings a company distributes in the form of cash dividends to common stockholders. Companies are always going to attempt to set their dividend rates at a level that will be sustainable, basically to keep your people investing into your company and their return on equity, what they really call about. But things could happen. A low payout ratio could mean one of two things. One, company could be in a high growth rate and are reinvesting the funds into the company. Basically, good times. The only reason why it's a low payout, because again, it's growing at a higher rate, and they can't keep up with it, kind of thing with dividend payouts. They'll eventually do it. On the other hand, with a payout ratio, a low payout ratio could also mean this. A low dividend payment is a signal of liquidity on solvency problems. Basically, they're trying to conserve cash. They're running out. So we always want to double check the company if there's a low payout ratio. Either see if it's a positive or a negative. So when we look at this, the formula is simple as this. I think the book has a spelling error. Again, I pulled this from the book, and they call it Payout Ratio. They spell that. That's funny. Alright. The formula basically is cash dividends declared on common stock. Again, specific on common. Divided by net income. So again, to give an example, here's our dividends. 821,727. There's our net income. Now all we do, basically plug them in the formula and divide. So, for this company, 2013, they had 29.4% payout ratio, but it has increased in 2014. So that means, hey, they're paying out pretty much more dividends. And we can actually see that with the numbers. But it increased our ratio. We like that. We've got more bang for our buck. The other ratio that we typically look at is called the return on common stockholders' equity, or basically known as ROE, ROE. Okay? And this is basically how many dollars of net income a company earned for each dollar of common stockholders' equity. So, how much money did we basically make off of the investors, the ones that purchased common stock? What happens is that this also gives the company the viewpoint of its stockholders. Because again, they want return on their investment. And if it's a low return, you're not going to have two investors. But if it's high return, yeah, you can make money very quickly. So, when we look at this formula, it'll be net income minus preferred dividends. You're probably not going to have preferred dividends. And they're going to keep away from that. That's usually, again, more close to 2301 when we talk about stock. But you're going to divide it by average common stockholders' equity. Okay? Watch out for the average. Okay? It means we got to have at least two numbers and divide by 2. This is usually your beginning equity plus your ending equity. So, for example, as you see the formula down here, 2014, and their net income, which again is this information up here since they're using the same company. That's where they got 2,693 minus 0 for preferred dividends divided by, here's the 2014's ending plus the ending of 2013, which is again the beginning of 2014 equity, divided by 2. Always do this formula on bottom first. Okay? If you don't, you're going to get a strange number. So here, we see from 2013-2014, the return has grown, which also is very good for stockholders. They like that. Even if it's a little bit, it keeps them happy. And they're like customers. You want them to be happy so that they keep investing. Alright. The last little item, which I'm just going to put this all on one page for me. There we go. The last item that they want to talk about, because of this chapter, and since it has where you saw basically debt investing or debt finance versus equity finance, is how does it actually look? Okay. So they give you, I don't give you a big problem, but basically it's how investors are going to look. They're going to look at the bigger return. I'm going to say this, for a company standard, bonds have a lot of advantages, but equity does too. So we're going to look at how they both affect. So, to illustrate the potential effect of debt financing on the return on common stockholders' equity, assume that Microsystems Inc. currently has 100,000 shares of common stock outstanding, again issued at $25 per share and no debt. Okay. It is considering two alternatives for raising an additional $5 million. Plan A involves issuing 200,000 shares of common stock at the current market price of $25 per share. Plan B involves issuing $5 million of 12% bonds at face value and we're not dealing with premiums or discounts. Income before interest and taxes will be $1.5 million. Income tax are expected to be 30%. Right. So a lot of numbers coming at you. But we're going to basically break it down. So Plan A is issuing stock, or basically equity finance. So here's our income. This is what they told us up here. Our income will be $1.5 million. Notice it's the same for both plans. And this is what we do when we try and compare to find the best decision for our business. Now, when we look at the stock, there's no interest involved, so our income before income tax is $1.5 million. They go ahead and figure out tax, how much tax we pay to the IRS, which again, they expect to be 30%. So, 1.5 million times 30% is 450,000. Subtract that, gets us our net income. So basically, this is what they just did. They took the 1,500,000 times 0.4, or not 0.4 times 0.3 for tax. That's how we got the 450. Then we took the income minus the tax. That's how we got net income. Now, they said common stockholders' equity is $7,500,000. This is due to this. Plan A involves issuing out additional 200,000 shares of common stock at the current price of $25 per share. Okay? Right now they have 100,000 that they issued out 25. That's the original stock. Okay? And this is how we see it right here on the bonds, because they don't issue out additional equity. Here, since they're issuing out additional equity, we would have to take 200K of shares, multiply it by the value that they're selling it for, so 500K, and add it to our current equity. This is where they get this $7,500,000. And then they're going to find out the return on common stockholders' equity. Again, our formula is up here. I think they just basically take 1,550,000 and divide by 7,500,000, because again, they're looking for the increase. So, Plan A, again, gives us 14% on return. Plan B, with the bonds. Bonds in itself runs the same course, except we do pay interest. We pay interest on a bond. Highlighting of that. So, we have about 600K that we will pay for the bond, about 5 million times 12%. Again, they're looking at the overall picture. So, our income actually gets reduced, right, to 900K. Multiply that by 30%, gives us an income tax of $270,000. Subtract 2, that gets our net income, and divide by our current common stockholders' equity. So they get a bigger bang or bigger return under a bond. And usually that's what looks good. Debt finance sometimes really looks good to investors. I'm almost really getting close to doubling what would happen if they issued more stock. So it looks good. It really does. Debt finance looks good, but the biggest disadvantage of debt financing is, again, that the company will be locked in to make the payments for the bond. And this means in good times and bad times, which your cash flow may actually have a stranglehold. It just will kill your cash that year, especially if you have to pay off the par value at maturity. So we do have to keep that in point. Again, the only thing we ever pay investors with equity is dividends. And we don't have to actually pay that. On your bonds, you do have to pay interest and the mature value, the par value. Okay? And I know y'all listened to me talk for a long time. About 2 hours here. So, that's it of chapter 8. That's every factor that goes in. And again, all you're doing is scratching the surface on a lot of these items. So again, on Thursday, we'll go ahead and go over the homework. So you can see how it goes. Okay? But I would like for y'all to go ahead and give it a shot. Okay? As cars are going crazy outside. But give it a shot. Try to do it so that you do have some questions when we get to the homework. And Thursday, that will be pretty much like our homework video. Okay? So I'm going to go through it. We'll go by step. Y'all can ask questions. If you want another example of that homework problem, I'll give you another example on the board. I'm going to use my whiteboard. And we'll get y'all through this. Okay? Now I hear thunder. Hey, everything's going on. It must be in the class. It's our bells. So, that will wrap it up. And again, the last exam is only chapters 8 and 9. And 9 is just basically formulas. I'll tell you that already. It won't take me this amount of time to go through them. Only a few new formulas, and that's it. But, again, if you do have questions about anything, you can email me, or you can send a message on Remind. Remember, your exam, if you haven't sent me the reminder already to tell me your decision, you again have until Wednesday at midnight to go ahead and retake your exam if you want to, with an extra hour, due to Wiley giving you all 3 attempts at once. Apparently that software does not allow you to actually retake the exam with the new time limit, or increases it on its own. It did all in the same time, which I didn't. I honestly, so booing, because that's not my intention. My intention was give you the actual 3 attempts on it, but that's why you have now until Wednesday to take exam 2, if you like to, with the extra hour. Or if you like the grade, I just add an extra 20 points to it. Basically all that's going to end up happening, you make this choice. That's just a reminder about that. Again, I already know a few of y'all already sent me your choice, But that's basically all it is. Let's just announce it again. So